Hi there, my name is Todd Miller, better known as Tightwad Todd. I created an 11-part video series as an introduction to personal finance. This is the seventh video, and today we're going to talk about investing and compounding. But before we do, just a little bit about me. I am a financial coach. I help busy professionals just like you transform a six-figure income into a seven-figure net worth. I am the creator of tightwadtodd.com, where I post videos, have a blog, and send out a weekly newsletter. So if you like my content, please subscribe. And I created this video series to help everyone get better with their finances, no matter where you are today. And here is just a brief overview of the topics that I'm covering in the video series. Again, today we are talking about investing and compounding. So, by the end of this video, you will understand the importance of building a strong financial foundation. We're going to talk about some of the tax benefits of portfolio and passive income versus active income. You're also going to recognize the most powerful wealth building tool that there is. We're going to talk about how some small changes can compound into huge results over time. So in previous videos, we talked a lot about savings. And each month that you're saving, you are living below your means, which means you have money to put towards your short and long-term goals. Not only that, but you're also increasing your net worth and you're putting yourself in a better financial situation. And one of the first things that we need to start doing is building a strong financial foundation. So, what is a financial foundation? Well, a financial foundation provides a strong base for you to build from. It helps you decrease risk and uncertainty. Unfortunately, ups and downs are a part of life just as they are part of the wealth building process. You never know if and when you may lose your job or when your car may break down or that may have some expense that you need to pay. So, part of building a financial foundation is preparing for these sort of things. So, some things that we can do to build our financial foundation is to pay down high interest rate debt. We can build an emergency fund, make sure that we have adequate insurance, make sure that we're following our spending plan and saving money each month, in addition to starting to invest for your future. When we invest, we're putting our money into an asset or a project with the goal of making a profit. We're able to reach our long-term goals significantly faster by investing than saving alone. In addition, when you invest, you get better tax treatment. Long-term capital gain rates that you earn on portfolio and passive income is lower and more favorable than what you earn from your active income or your W-2 job or the business that you run. You don't pay any sort of FICA or Social Security tax. And when it comes to investing, we really need to think long term. Now, when we invest in assets, and assets have differing degrees of risk, which can affect the rate of return that you receive. So we need to talk a little bit about and think a little bit about what kind of an asset you're comfortable investing in. So some examples of assets are certificates of deposits, treasury bonds, stocks, stock options, and a whole host of other different things. So let's go through a quick example of investing. So let's imagine that you have $10,000 to invest and you buy a CD that pays 5%. So at the end of the first year, you'll have spent almost no time, but you'll made $500 in interest income. That's pretty cool. I like that. The phenomenon of compounding occurs when your interest starts earning interest or your investment returns start earning investment returns. Over time, this leads to exponential growth. And for the best results, you don't want to interrupt compounding unnecessarily. And what that means is once you start investing and seeing your investment account grow, you don't want to start pulling money from that account. That hurts compounding and its ability to grow larger exponentially. In addition, it's important to realize that compounding is responsible for the majority of your future net worth, not the amount you save. It really has to do with the amount that you invest and how long you can allow it to invest and compound for. So let's take a look at a quick example here. Let's assume, like we did in the last example, that we're buying a CD at 5%. So in year one, we're going to have $10,000 in principal and earn $500 in interest. Now, if we reinvest that $500, we now have 10,500 in principal, but we'll have earned $525 in interest. And then if we reinvest the $525, we now have $11,025 in principal, and that's going to yield us $551 in interest. And then if we do the same thing, and now we have a principal of $11,576, then that's going to earn $578. And the really cool thing about compounding is that this continues forever as long as you don't interrupt it. So as long as you leave the initial $500 invested in your account, then it just continues to earn interest for you forever. And I think that's really cool. So let's take a quick look at exponential growth and what it looks like visualized. So here we go. We start with an investment, and over time it doubles, and then it doubles, and it doubles, and it just keeps doubling. And we look at this and we refer to this as the rule of 72. And this is the estimate for how long it takes for an investment to double. So in order to get a rough idea on how long that takes, we take 72 and then divide it by the annual rate of return. So if we go back to our previous example of the 5% CD that we were using, then we would take 72 and divide it by 5. And so it would take roughly 14.4 years for our investment to double based on a 5% CD. So let's take a look at a long-term example of compounding. Let's assume that Sally Steady starts investing $500 per month at age 25. If we assume that she earns an average of 8% per year, how much will she have at age 60? So here's an idea on what it looks like visually. Over time, it goes up and to the right, and at age 60, she ends up with over $1 million. But the really cool thing about compounding is that she will have only put in $210,000 into the account, which means over $800,000 is from investing and letting it compound over time. So let's take a look at another example of compounding. Let's assume that Sally now took this class and was able to save and budget, and she was able to invest $750 a month instead of $500. So what does that look like over time? Well, the graph looks very similar, except the numbers just get bigger. So this time, instead of having over $1 million, she ends up with over $1.5 million. And again, she will have only contributed a fraction of that. So in this example, over $1.2 million is due to just letting the money sit and compound over time. So let's take another look at a real world example of compounding. Let's assume that you need $1 million to retire. And let's also assume that you can get an 8% return on your investment, and you could really end up with $1 million in any of the following ways. The first way would be you could invest $14,220 per month for 5 years and end up with $1 million. But you'll have to save $853,200 if you do it that route. Another option would be you could invest $5,760 for 10 years. That would also get you to $1 million, but you're going to have to still save $691,200. Another option would be to invest $3,070 per month for 15 years. That would still get you to $1 million, but it's going to require that you save $552,600. Another option would be you could invest $1,825 per month for 20 years. That would also get you to $1 million, but you only have to save $438,000. If you did $1,140 per month for 25 years, that would also get you to $1 million, but you'd have to save just $342,000. And if you save $740 per month and invested it for 30 years, then you'd end up with $1 million, but you'll have saved just a fraction of all of the other options at just over $266,000. And this is exactly what's happening with your money. When you decide to delay investing, then you're making the decision that you're going to have to save more money in order to reach your goals. So the choice is yours. There's a number of things that we can do to maximize the power of compounding. The first one is starting today. Time is an investor's best friend. And like we talked about earlier, you don't want to interrupt the power of compounding unnecessarily. And one way that we do that is we build a strong financial foundation so that we don't have to pull from our investment accounts unnecessarily. In addition, we should be mindful of the fees and taxes that we pay associated with our investments in our investment accounts because these slow compounding down. We want to strive for consistent returns. We don't need to hit home runs or take on crazy risk in order to take advantage of the power of compounding. It's also important to invest more money when you can. So part of the reason that we use a budget is so that we can save more money and have more money to invest. In addition, anytime that you receive a raise or a bonus, it's important to allocate part of that money towards your investments. Just like with your tax refund or anytime that you receive any sort of a financial windfall, part of it should be going towards your investments and part of it should be enjoyed. Well, that's a wrap for this video. Coming up next, we have the importance of tracking your finances. I appreciate you being here with me and look forward to seeing you in the next video. Thank you so much.